Hi, good evening, everybody. Welcome to Endowus Live, a webinar for Endowus customers and everybody who is interested in finance and investing. We are here again at Arc Spaces, wonderful space in One Marina Boulevard, and we will be presenting our last Endowus Live webinar of the year. It's been an amazing year, tumultuous year, and painful at times. But it's been a year of survival for everybody and hopefully thriving for some others. Tonight we have an amazing panel with us today, three of the most brightest minds and also the most well-known personal finance website co-founders who will be sharing a lot of personal stuff. So maybe just a quick hi from everybody.
Hi everyone, I'm Peter from the InvestQuest. Pleasure to be here.
Hey, I'm Dinesh from Dollars and Cents. Very happy to be here at the Arc Spaces as well.
And hi everyone, my name is Derek, and I'm from Better Spider, and really excited to be here.
Can we span back to Peter with the right title? Yes, there you go. All right, so it's great that everybody's here, and we will be discussing the best and worst moves of 2020, focusing mostly on our personal journey of investing. Maybe if I can switch to slides and introduce and some of the housekeeping. We always have to have a disclaimer as a regulated financial entity. And the next page will show that we will be doing a Slido. Just to, another plug for the Endowus YouTube channel. We're actually live on YouTube and Facebook at the moment. So thank you for joining us, for those of you who are joining us live. And thank you for all of you who are watching afterwards. But there's great content on the YouTube channel. And so please take a look and please subscribe. And any new ones in the new year will be delivered to you and highlighted. Next page, just want to once again let you know that we're using Slido. There's an event code there which you plug in when you go to the website, and immediately it will take you to two things. One is the poll that we'll be holding, and also a quick Q&A area. And the Q&A area, you can put any questions you like. Please put them up during the whole course of the webinar. And we will definitely get to it. We may address a few during the course, but we'll definitely answer as much as we can at the tail end of the webinar. And also, you can upvote the questions that you like. So even if you didn't ask the questions, you can select and vote up the questions, and we'll definitely try to prioritize those questions that more people want answered. Next page. So this is the question on the poll right now. If you go into the Slido app or the website, what is your greatest money management problem in 2020? And you'll have four answers that you can choose from. One is job security and pay cut. Second is cancellation of plans that we had. C, low interest rates. And 4, got money but nothing to buy. So that's an interesting fourth choice for you. So these are the four choices that you have that's come up. And maybe before we get going, maybe a quick, just to warm up everybody. And I didn't prepare anybody, so this is going to be out of. Which one would be your answer, Peter? What is your greatest money management problem in 2020? It might be number 2.
Maybe number 4.
Number 4?
Yeah,
okay.
the reason is because recovery was so fast.
Okay,
right?
okay. But you also had many plans this year that got cancelled.
Yeah, that's right.
Okay, Dinesh, what about you?
Yeah, I think cancellation of plans, definitely something that played into this year for us.
Yeah, okay. Right. Derek?
For me, it would be like low interest rates because there's no way to put my cash.
Okay, wow, interesting. All different answers from the four of you. I can't do pay cut because I'm not getting paid much at Endowus, so okay, so I'm just going to move on and do a very quick introduction to Endowus for those of you who are new to us. So Endowus' mission is to help people invest better so they can live easier today and to live better tomorrow and through to retirement, which is arguably the largest, the most important generational challenge we face as a society, is to really fix retirement adequacy. Next page. And we really began with the problem, the pain points that we experience ourselves trying to invest our own money personally. It's really very difficult, and the systematic problems of investing exist here in Singapore, and it's a problem across Asia, that the experience is broken because of a lack of aligned advice, lack of access to great products, and the high cost of investing, the combination of which leads to poor outcomes. Next page. And the solution is Endowus, in our mind, obviously. A new wealth experience, digital, hyper-personalized, holistic. We give access to better financial products. For example, we were the first and only so far guys who can give you access to passive index investing for your CPF money, for example. So we solved that problem. So we're really trying to think differently, giving access to institutional share class for individual investors, for example, through group buying, and really trying to lower cost at every opportunity, at every layer, which will lead to better outcomes. So we're not just another robo who are trying to develop an algorithm to beat the market. We're a total wealth management platform. And the proof of that is the fact that we are the first and only digital advisor for CPF investing. We are able to manage all the source of your funds, which is whether it's cash savings or CPF or SRS. So it's a platform really for all of your wealth needs. And why our clients choose us? We're independent and we are strictly fee only, so we receive no payments from anybody else. If we receive anything, we pay that straight back to the client. So 100% trailer fee rebate, and fully independent and fee only. And we focus on the things that we believe will make the difference, which is advice, access, and cost. Next page. And the team's grown now. We have 36 going on 40. We've built our own tech stack, which is very unique. And our experiences are very broad across financial and technology. So we like to say we're deep tech, but we're also deep fin. So we're really trying to solve all of these problems with a team that is excellent at what they do. Next page, please. And we partner with people. So we're not trying to solve everything ourselves. We stand on the shoulder of giants. Two things, I think, on the fund management side, where we typically call them product or manufacturing. We work with some of the biggest fund managers managing trillions of dollars who have proven track record over decades. And we select and curate and personalize the best portfolios for you and select the best funds for you as well. And they're all Sing dollar denominated, tax efficient ways of accessing great investment products. We also partner with UOB Kay Hian, through whom we create a separate trust brokerage account in your own name. So that is a way to safeguard your assets that, in the worst case, even if Endowus disappears, you'll still have your money and have access to it, and you'll be able to continue to invest without any disruption. Next page. So just a couple of quotes from two of our partners, the CEOs of PIMCO and Dimensional across Asia, just confirming that Endowus really is differentiated and a significantly differentiated wealth platform from the others. Next page. And we really one of the key things about Endowus is we're really missional about financial education and literacy. We do understand that this is key, and that's why we're so excited to partner up with the three panelists here today. But the next page, Endowus Insights has been around since 2017. We started publishing before we even launched any kind of commercial service. So we started with the mission first, which is financial education literacy. Almost 200 articles, over 1 million views on the written content. And then since March, with the lockdown, we converted to webinars, which is where we are. And it's amazing that we've done so much in such short time. We've had a regular weekly cadence and sometimes 2-3 a week. Almost 20,000 hours of viewing, 70,000, 80,000 of views in total. So that's amazing what we've been able to achieve this year. And thank you to all of you guys for really making that happen. Next page. And seminars, community education outreach. Actually, you can see on the top left, it was an SGX webinar, and we had, I cannot see the picture from this far, but I think it's Kenneth for one person, and I can't see who the other one was. But yeah, we definitely had like great speakers where we collaborated with SGX and other community members as well. Next page. And we've been much more active recently, so you may have seen some of these things. Some people called and said, well, your marketing guy looks pretty good, and that's not our marketing guy. All of those guys are clients of Endowus. So it's a client advocacy program across MRTs and outdoor and office spaces. So if you see the name and then what their job is, underneath it says client of Endowus. So these are real clients who we didn't pay, they're not models, who really love the product and have been able to, who came forth to provide advocacy to other people about the service. Next page. And Endowus has been in the press. Next page, please. We actually have a dedicated column in Business Times called The Science of Wealth. So that's, if you haven't checked it out, please do so. There's great content there. Next page. And recently we, put ourselves on the Grab mobile app. And on the Seedly community, we're rated as a #1 robo-advisor in Singapore. And as a result, this year, we've grown quite tremendously. So 20x growth in number of clients and 7x growth in assets. And we have all of you, our clients and patrons to thank. So thank you again as we wrap up the year. And this page tells you all. This is a community. It's not just us. We're part of a broader community that is trying to advance financial literacy and improve financial education. And obviously, I rejigged it so that we have the 3 panelists, logos at the top. And I just wanted to, show that InvestQuest, amazing graphics and stuff, dollars and cents. You guys have been around for so long. You've done a fantastic job. But Derek, Better Spider, the logo, I couldn't find anything other than that. Well, can you explain how that logo came about? Yeah. Then behind the name. And while you do it, I think it'd be great if we can, maybe switch off the slides for a bit, and then just let the speakers maybe, take the opportunity to, first of all, introduce your personal finance website, Better Spider, Dollars and Cents, and InvestQuest, and also share some of your personal stories. How you began the journey, where you are. I know one person's married with a kid, and one person's gonna get married. Is that right? Gonna get married? Is that official? Yeah.
Not yet.
No, not yet. Sorry. Okay, so before pre-marriage then. Pre-marriage, marriage, and marriage with kids. So maybe we start with Derek, and then we move this way. Maybe just introductions.
Thanks, Derek. So my name's Derek. I'm the co-founder of Better Spider. And just to give you guys what Better Spider is all about, we started 2 years ago as a platform to really inspire people to become better versions of themselves. So we cover topics ranging from personal finance to personal growth and development. And ultimately, we want to bring our content to really inspire people through knowledge that's not really taught in schools. So it's a really interesting journey for me. So we are launching a new Instagram page, so keep a lookout for that. On the personal side, as you said,
not married.
Not married, going to maybe.
Maybe.
But so the personal finance journey for me has been really interesting. I had the opportunity to really start early in my life. When I was, I think, 14 years old, I started reading a book, and I think it's a very, very popular book, Rich Dad Poor Dad. And that really started me thinking, how do I manage my finances? How do I think about cash flows and so on? So that really gave me the foundation to really start in this whole area. And then went on to study accountancy in university to strengthen my knowledge, and also this whole journey of Better Spiders really to inspire more people to along this journey. Yeah.
Great. Okay, Dinesh, maybe?
Yeah, hi. So I'm Dinesh, co-founder of Dollars and Cents. We started in 2012, I think a little bit before that. And we started because me and my co-founder were in the same university, and we were studying finance, econs and finance, and we realized we didn't know how to invest in a single stock. We hadn't bought a single insurance for ourselves, and we were studying finance. So it shouldn't really be the case. And we just went out there and started trying to learn for ourselves. And I think back then there weren't many platforms around. So what we did was just localize some of the stuff that were already out there, but for the US market or UK market, the bigger markets, just localize them. And also went out to reach out to maybe the agencies, CPF, HDB, just find out a little bit more, and then put our content out. And from there we saw traction come along a long way. And then obviously as time went by, I think 2014, 15, we started seeing a lot of other finance blogs start to pop up. I think it's good. That means really more people are going online to search for information. And that's where we also took the plunge. So I started working with someone else first, and then now I'm doing it full time. And that decision came about in 2016 when we saw that traction. We saw more people going online, more advertising dollars perhaps going online. And we took the plunge at that point because I didn't have any. Now I'm married with a kid, so I'm one of those guys.
You are the guy.
I am that guy. Yeah. But back then I didn't have a kid. I wasn't married, so it was a lot less scary, a lot less financial pressures, obligations for me to take on or have to pay out every month. And I could afford to go full time. So that's how we started our full time journey into making it a job, a company, a business. And personally, obviously, as mentioned, I'm married and I have one child. He just turned 1 year old this month.
Wow, congrats.
Yeah. So I'm actually growing with him every step of the way. So when he said his first words, it's just gibberish, but you think, oh wow, this kid is saying something. Let me try to understand it. And then when he takes his first steps, I take him swimming. So when he falls and entirely submerges himself into the water, so everything is a learning process. And I think it's similar to like the finance journey I've had. Every step of the way, it's a learning process as well. No matter how knowledgeable you are, there's always someone more knowledgeable, or there's always something else to know about a certain topic.
Okay, that's
Since you
great,
missed the COVID baby bonus, it's time to have a second one to average down.
Yeah, that's what everyone keeps saying.
Yeah, and we'll share about the times when in our financial journey we fell into the water and was almost drowning.
Yeah.
Those journeys too. Okay, Peter.
Hi everyone, my name is Peter. I'm the co-founder for the InvestQuest and Endowment Exchange. Prior to this, I was actually an investment advisor, servicing high net worth individuals and family offices, first at JP Morgan and subsequently at HSBC. So just give you a brief introduction to the InvestQuest. It is a finance blog. We write about multi-asset investing, and we do so with retro gaming graphics to make it a bit more approachable for our readers. And for Endowment Exchange, it's a new venture that my wife and I are currently doing. We are currently buying endowment and whole life policies at a price that's above the current surrender value of these policies. And in so doing, we hope to achieve a win-win situation with policy owners who are thinking of surrendering their policies by offering better value for them. But at the same time, for ourselves, we are also able to invest in these policies with a relatively higher return and also a shorter time to maturity. So currently I'm 31 years old, married with no kids.
Okay, so the married one. So we got one of each, and I'm married, so just making it clear. I'm much older, but I have 3 children. I have a 15-year-old boy, 14-year-old boy, and then a big gap, and a princess, 7-year-old daughter. So quite a journey, individually and personally. I was on the institutional side, running asset management, tens of billions as a professional investor at a place called Morgan Stanley Investment Management. And I've been around for 26 years in the industry, so it's quite a long time. But I learn from these guys all the time because a professional investor doesn't know everything. They only know that space that you're in. So for me, it was macro asset allocation for a bit. It was public market equities, growth equities for a long time in Asia and parts of emerging markets. So everybody is very, very siloed. And when it comes to personal finances, it's a whole different ball game, right? So we're going to kick off this year, kick off the discussions, discussing this year. It's been a very difficult year for many people. Many people have lost jobs. We've seen pay cuts. Of course, we've received also checks from the government and support from family and friends. But it's been a very, very difficult year for many people. And we all know stories of people who are suffering and struggling. So with that backdrop, I was wondering if you could maybe each of you share some stories about the people around you, your own experiences, and especially maybe tie it into, since it's a personal finance investment related webinar, into some of the stories of how you've managed your finances this year, some of the interesting tidbits that you can share. That'd be great. So we'll start from Derek.
Yeah. So I think, as you mentioned, like the economy has been really tanking. I think people have lost their jobs. Fortunately for me and many people around me, I think they have kept their jobs. At the same time, they're also looking into what the pandemic has brought, the changes that the pandemic has brought, especially in terms of digitalization, in terms of upskilling, because as we move towards more remote work, people are seeing that some of the jobs can be automated away, can be moved mobile, can be done globally. So I think a lot of my peers and me especially are looking at steps, at ways to improve ourselves, especially taking up courses online, taking up certification, and so on. On the personal finance side, I think looking at the markets and the volatility, especially so when interest rates are falling, there are a lot of people are really unsure about where to put their cash and how to invest them. So I think for me especially, I feel that my personal finances are still quite stable, and especially when planning for BTO in the future, for wedding expenses, I make sure that this pot of cash are actually put in place so that regardless of what the market does, I do not touch them. But at the same time, looking at the long-term perspective, I think we should be able to take a more macro view and understand that these are more short-term fluctuations, and we can always invest for the long term. Yeah, so overall, to wrap things up, I think for me and my peers, we are quite aware of what's going on around us. We are trying to take steps to upskill ourselves and make ourselves relevant, especially in a changing world.
That's great.
Yeah.
Dinesh, you wanna-
Yeah, no, I think Derek hit the nail. Digitalization is a big part of the theme this year. And in that respect, I think Dollars and Cents, and maybe perhaps also definitely the other publishers out there, we've seen more eyeballs go on Dollars and Cents, especially during the circuit breaker period in March. And when I say circuit breaker in March, I mean the S&P, when it really hit circuit breakers on a few days in a row. That's when we saw really investment topics and investment articles really start to shoot through the roof, eyeballs coming in. People are really interested in investing. I'm not sure whether for the right or wrong reasons, right? We saw on Robinhood in the US what's happened there. So the markets have been very volatile. It crashed downwards, but now it's already back up way above the all-time highs. So I think in the market-wise, things have been good. But obviously in the economy, things haven't really been great, right? I think all of us have our personal stories to share. I think personally, at Dollars and Cents, because of digitalization, we've kind of benefited a little bit. The government support has also been very beneficial for our company to maybe spearhead new initiatives. So that's good on the business front. But personally, I think we each have stories. So one of my two actually stories to share. Firstly, my brother was due to get married at the early part of this year. And he was going to get married in Malaysia actually. So we had planned like a wedding in Malaysia. And it was just the week after the circuit breaker was announced. So we were still planning to go ahead with it, even though concerns were rising. But after the government announced, it wasn't circuit breaker, it was like code orange. The doors gone orange when it hit. So we decided, orange is, it sounds like a risky color. So let's stop all that planning. But unfortunately, we had paid deposits and we had paid the vendors already. And I think that's just the uncertainty of doing it in a foreign country sometimes. We couldn't get the deposits back, so it's still sitting with the respective vendors in Malaysia. So that may be one of the things we didn't plan for properly. Maybe you could have staggered the payments a little bit more. Learning point for us. We had booked our flights and all that, so those monies were stuck. Some of us who booked with SIA, I think they were a bit more generous with their refund policies. Other flights, maybe not so much. Then my dad, who's a tailor actually, I think he was impacted, so he couldn't really do his business anymore. He shut for a while. Now he's reopened again in a smaller office space. So I think our family was impacted. I think personally, we all know people who have been impacted as well. So it's been a topsy-turvy year for everyone, I think.
Sounds like it for your family, especially.
Yeah.
Peter.
Yeah, so I
have you
think
coped?
I don't know. On the mass media, you always see that retail, hospitality, aviation. These are the sectors that have been the most heavily hit, getting a lot of government support. But there are also certain demographic groups which are especially vulnerable. So one of which would be your individuals who have very little or no working experience, such as your fresh graduates. They are going to find it increasingly tough to find a job this year. And on the other spectrum, we also see that there are the very, very experienced hires, but because of their experience, they are also being paid quite generously. And this group of people will be at risk of being retrenched as well. For my peers, I would say that a lot of us have been working between 5 to 8 years. And because of that, I feel that we are in a sweet spot. We are not paid as much as some of our more experienced colleagues, but at the same time, we have garnered sufficient experience to a certain extent, take up some of the more senior responsibilities. So I've actually been seeing quite a number of peers moving between companies this year. And the rationale for that is because the bonus pool for this year for many companies is likely to be below average. And so because of that, the opportunity cost of moving firms this year is actually much lower. On a personal basis, my wife and I have been thinking about how can we also do a social element when it comes to investing. And that's why we started Endowment Exchange, where obviously we try to buy policies from the policy owners at a better price than what they can get from the insurer itself.
Since we're doing the best and the worst of 2020, what is the worst mistake you made in terms of managing your cash flow? Because there was so much uncertainty this year that it was very difficult to manage the cash flow, right? And Dinesh alluded to one event, for example, where the cash flow just disappeared on you, right? Because, it wasn't your money, it was your brother or your dad, but whoever paid for it.
Yeah.
But any mistake that you made this year in terms of managing your cash flow or, doing things that you regretted?
I think hindsight is always 20/20, right? So to say you regret now, I think everyone would say they regret they not having done something a few years ago. But I think one of the main things I learned is maybe have a bit more cash buffer to take advantage of 50% crashes in the market. So I had only set aside enough cash for maybe going back into the market a couple of times. So my strategy or something that I do is that whenever the market goes down 10%, I try to go in another sum and another 10%. So I go in another sum. But when it went down 30, 40, 50%, there was not enough cash buffer to go in the markets anymore. Yeah, so I think that's one of the mistakes I made.
Okay. How about you, Derek or Peter? Anything to add?
I think similar to Dinesh, but also I think I spent a lot on transaction fees this year, trying to trade the markets, spending I think a few hundreds of dollars, just trading. And I think it's not really a very good strategy. I think buying and holding is eventually going to be a better strategy, unless you can perfectly time the markets. But like Dinesh mentioned, markets keep tanking, so you can be trading and trading and trading, but ultimately you're spending a lot of money going out.
People forget about the cost of trading, right? Yeah, that's right. You want to add?
For myself, it's more on air miles.
Oh,
so I hoard a lot of air miles, and I actually had some serious plans to travel this year. So I bought miles speculatively last year. I spent $10,000 buying miles last year.
So you added to it?
Yeah, so all of which I have not used. And then adding on to all the previous miles I have in my frequent flyer programs, my credit cards.
Are there any expiry for these miles?
So it depends on credit cards. Some of them, the points can be there indefinitely. But once you have transferred them to a frequent flyer program, typically there's an expiry date for many of them. So now my mileage balance is 1.6 million miles.
Wow.
Which, if you convert it to how many flights I can take, it's 8 return tickets to Singapore to New York in business class.
Wow.
So that's about almost $50,000 in value. And that's a huge opportunity cost because when the market tanks this year,
Yeah.
there's so much less
right.
gunpowder for me to enter.
That's right.
Yeah, and also you must remember that miles are a depreciating asset,
Yes.
right? You don't earn interest, and there's a risk of devaluation by the airlines over time.
Yeah, because they always change the mileage plans, right?
Yes,
So
that's
yeah,
right.
that's true. But we can take solace in the fact that this year is a year that no one could have predicted. So
Yeah.
I think and to Derek's point, it's impossible to really time the market well, right? So we're just going to go back to the slides because we have the Slido poll results first. I think we can put it up, but it's a surprising result. I mean, I'm shocked at the result. 69% is low interest rates. So I guess a lot of people have a lot of cash sitting in their banks, not doing anything, because that's normally why low interest rates is the biggest problem. And we'll get to that later because I think it also reflects on investment behavior, right? Because you normally, I think, especially here in Singapore, someone just voted, nothing to spend on. But we can go to the slides as well. I want to show some slides because we talked about markets this year, and I think it'd be good to just maybe have a quick recap on the slides before we go back. But we have another Slido poll that's going to begin because we closed that one. And this is going to be really about your investment regret. What is your biggest investment regret for 2020? So we'll have that up. So during the next phase, people can answer the questions. But we'll get to this one later. I'm not going to ask you to answer it because we're going to delve into this in a bit more detail. But before we do, I want to share some slides and a recap of markets this year. This is what transpired. Equity markets fell more than 30% from peak to trough and recovered. So this is, I think, only to our year in review report. So since then, obviously, we've gone higher to new record highs. But what's interesting is actually the turquoise greenish colored line, which is the Bloomberg aggregate, which is the bond index. So people make a big deal about how the bonds didn't protect us, it fell, and it's not, diversification didn't really help us. But look at that chart. I mean, how can you say that when you look at that chart and say that the bonds and certain segments of the bond market did correct? And it was a very unique circumstance because there was a global liquidity shortage, and especially in US dollars. And as a result, people sold US dollar liquidity. The most liquid US dollar asset was treasuries. And so the safest asset class was disrupted. And so prices fell, which means that yields rose and the spreads widened significantly. So fixed income saw one of the biggest disruptions in the history of mankind during the March of 2020 this year. But since then, obviously, quantitative easing, asset purchases from the Fed, and we've seen the fixed income market recover first, and then equity markets, obviously, and all financial assets do much better. Next slide, please. And March was no ordinary correction. If you look at the history, based on the US numbers, at least, it's the 5th biggest fall in the history of mankind. But the next slide will also show that it was not only the fastest bear market, but also the fastest recovery. So the first one is the Great Depression in the 20s, and people forget that there was quantitative easing and it was a major inflection point. Same thing happened in 2008 during the global financial crisis, where it was down 18 months and then it took a full year to recover. But the amazing thing about this year has been the speed and rapidity, and we'll touch on this because it didn't give us enough time to react, right? And do things that maybe we could have done. So the next slide. And this is, what we end up with, because, through the cycle, what we underestimate is actually how the market ends up going up for much longer. And all those corrections that we thought was the end of the world and major corrections of, up to 50% in markets was actually rather short. Normally 12 to 18 months at most, often very shorter, like this year. And obviously the right thing to do is not to sell into that fall, but to continue hold, because the market recovers and goes and makes a new high and trends upwards over a longer period of time. And the next page. So this is a couple of charts from our year in review. So Endowus published a 2020 year in review report that you can actually find on our insights page, and you can download, but it has a lot of insights about Endowus and our clients as well. But there's a couple of slides about our client behavior that we were able to observe. So the behavior during January to September, you can see that on a monthly basis, obviously many more people, 70% plus on average, continue to invest every month versus the low single digit percentage of people who actually redeemed money. This is not always borne out, because in the US we saw numbers in the 20-30%, especially the older generation wanted to protect their capital and sold out a little bit too early, or sold at the bottom, which is very painful for them, right? But in our experience, maybe it's just the effectiveness of Endowus live webinars and education, but our clients have been very sticky and sticking to their guns during this cycle. Obviously, they invested less. You can see March and April, people did get some sticker shock and get a bit scared, and so they didn't deploy money on the way down as much as maybe we thought. And there was a slight pickup in redemption in March, obviously, as the market came down, but it wasn't like a major number. And the next slide shows that investment behavior in terms of login frequency. So back then we didn't have a mobile app, so we just looked at the overall login across platforms, and you can see that actually people, this is people who did not log in, right, or logged in 10 times or less per month. So 10 times or less a month means, just every, 3 days or 4 days. So even in March, surprisingly, that, people didn't log in that frequently. So it goes to show that clients, our clients at least, and so, you can brag being an Endowus client is being wise and long term, and but they tended to have a buy and forget approach. So it was very interesting for us to find these data, and there's a lot of other data that we shared in the year in review, and we'll also share in the future with our partners and colleagues. With that, the next page I think is sorry, this one we can skip. We can do that later, and then the Slido event, we can remove the slides, and so Slido poll, I think you can choose the Slido poll. If we can have the Slido poll up again, and then we'll talk to this, and we'll give an opportunity for you to, so far, the biggest investment regret for 2020 obviously is not buying in market lows. As a human being, it's impossible to do that. But I think if you had a disciplined monthly regular savings, that could have helped. Or if you're a contrarian by nature, that also helps. But that's the first one. Next one was not enough war chest. So that was a regret that, I think that's Dinesh. Yeah. But it's impossible, right?
Yeah.
Because we talk about how we do the lump sum versus regular savings and how dollar cost averaging. And technically, because markets move up, you should actually lump sum. That's the theoretically the right answer. Yeah. But in reality, it's not that easy to do. But also we have cash flow coming in on a regular basis, and how we manage that and invest on a regular basis is also important to outcome. So maybe we can take turns and answer one of these. Which one is your biggest investment regret for 2020? And then flesh out some of your answers about how you managed through the crisis of March of 2020, the first for most of you in your lifetime, right? So it'd be great to maybe share that. We'll start in the middle this time, Dinesh.
Okay. Yeah, so I think you're right. It's the first kind of major crisis for us. I think we've seen some mini ones that seemed pretty major when it happened. And then this is the first major, okay, this is the crisis. So in 2008, I was still in school.
Right.
And fortunately, actually, because while everything was going downwards, to use a proper language, I was in school getting my education, right? And then not really being impacted because everyone else was, who were working, who had investments, were involved in that bloodbath. And I didn't have a single cent invested in at that point. It was only towards maybe 2011, 12 where I started getting interested in finance, investments, and the website that I started putting some money in. By that time, it was already on the way up. So I think many of us actually who started at that point enjoyed like 10 years, almost 10 years, like 8 years worth of bull run, which is also one of the longest bull runs in history. So when that happened in March, most of my money was obviously invested, which is why one of my biggest regrets was not having enough war chests, right? If you don't have enough money invested, then you complain, oh, maybe I should have invested everything. And I guess that's just human nature sometimes. But I think following your investment strategy, so when the markets went down, I invested in. It went down again, I invested in again. Unfortunately, I ran out of war chests by that point at the trough. But that is a missed opportunity, but it's fine. I stick to my principle, I stick to my strategy, and at the end of the day, it still came back up beyond the points that I bought on the way down. Yeah, so I think at the end of the day, the strategy worked. I'm going to stick to it. It's something I tell people to do, so it's something I should be doing.
But did you go in and out or just in?
No, I'm kind of a hodl person. So I just held all the way down. It's quite scary sometimes seeing real money losing that much value at that quick of a rate.
Yeah.
So when I first started, I had maybe like 10,000 back in 2012, then $20,000, and to see 20,000 go to 5,000, 10,000, half its price, it's not that painful, although it's still 50%. But if you have 100, or to exaggerate, $1 million in the markets, and you see it go to 500,000, that is can be quite a shocker. Can be life-changing for some retirees who sell out at that point. Where you mentioned in the US, some of them did. Yeah, so real money plays a big notion. Having someone like Endowus to coach you along the way probably helps. Having mentors, having someone to discuss, bounce ideas with, tell you to stick to the strategy you've agreed to at the start. Yeah, that helps. Yeah, so I guess Endowus is doing a great job as well with your webinars.
Oh, thank you, Dinesh. And I think Dinesh just fessed up. He has $1 million of investments.
No. I'm exaggerating. Yeah, I didn't want to say how much I had. Right?
Okay, who wants to go next?
Yeah, I can go next.
Yeah.
So during the March sell-off, really I was thinking to myself, the best time to invest is when there are 4 sellers in the market, right? And in March period, there were actually...
Sorry, Peter, where did you learn that? Just for the audience, that...
I think it's through work experience.
Work experience, got it.
Essentially, that was a good time to buy, right? So I personally had invested some into stocks, into high-yield bonds during that time. But I wanted to take a more strategic approach as well, because I knew that for most historical recessions, the bottom doesn't come after a month, right? So what I did was to look at the prior 4 recessions that Singapore had encountered since our independence. So mid-80s we had one. We had one for the Asian financial crisis, the dot-com bubble, and then the 07 to 09 crisis. And during these 4 prior recessions, the Singapore stock market actually took between 9 months to around 14 months before it actually bottomed, after the first negative GDP print was published. So in my view, in March, I thought that my rough estimate was that the market was going to bottom somewhere in September 2020 to February 2021. So my strategy was really to deploy 10 to 15% of my full intended investment amount per month, such that by September period, I'll be fully deployed. And if the market was still weak at that time, I was open to using leverage to invest.
Wow.
Yeah, but in retrospect, the recovery came a bit too fast. So, yeah.
Great strategy, but the recovery came too fast before you could implement it. Yeah. But it was, I don't know how to put it, but yeah, I guess it's kind of sad that, all of you guys saying that this is your first real crash, and then you talked about all those examples of previous crashes, and I worked through all of that.
So you have to share what your strategy is.
I'm pretty old, man. Yeah. Strategy is actually the learning, that Peter mentioned is from experience, right? Having lived through all those crises. And I wrote an article in the throes of the crash at the bottom of March. I shared my story of Barton Biggs, who was a global strategist at Morgan Stanley, and how he walked into the offices of Morgan Stanley Investment Management Singapore in 2009, early 2009, when we thought, the world was going, is going to disintegrate, that we were all going to lose our jobs. Morgan Stanley was going to go bankrupt, and the end was nigh, and we said this is worse than the Great Depression of 1928, 29. And he came into the office and we asked him, is this the worst thing you've ever seen, Barton? And he said, well, maybe 1973 was worse. And we're like, what? 1973? We knew it was a bear market, but we didn't even know what 1973 really meant. Because the worst reference point we always use is 1929, the Great Depression. And so in 2009, he told us that. We thought, okay, he's 80, he's senile, he doesn't really know it. He's not really feeling it because he's a billionaire or whatever he is. And so we dismissed it. And within a few weeks, I was walking in Holland Village at this magazine store. I saw this Newsweek article which said, buy, in bold yellow and black, by Barton Biggs. An article written by Barton Biggs on the Newsweek, just a few weeks after he visited our office. It was back in New York. And I was like, oh my goodness, he's at it again. He's a perma bull, he just can't get it, But I actually just wanted to buy all of the magazines that were there. I think they had 7 or 8. I brought it back to the office, distributed it to the team, and said, let's see what happens. And within weeks, that was the bottom of the market. And from then on, we saw, some of the strongest recovery that effectively has lasted until today. So it's pretty amazing what experience can provide you. It gives you context. It can give you, I think, to level your head during a period when everybody's losing theirs. So I wrote that reflection, not knowing that this was going to happen. Obviously, I can't predict the future like any other human being. But it gave me great perspective that it's not the end of the world. That sometimes these things are, these things have been experienced before by previous generations. And it was interesting that I actually thought that, like Barton at the time, this crisis was very similar to this 1973 crisis, not 2008, but 1973, because a lot of external shocks happened at the time. The oil embargo, oil prices shot up, inflation shot up, Nixon resigned, a lot of external shocks. And so the market recovered relatively fast then, nothing like this time, but that was an interesting journey for me. But we left Derek to the end for a reason.
Yeah.
So Derek, maybe you can share your journey this year.
Saving the best.
No, I think like you guys covered most of it. But personally, to add on also, I think time in the market beats timing in the market, and that's something I also picked up along the way, where you can't really predict when the market will crash, and I think the speed of crashing was really too fast. It was the first crash, obviously, for me, and psychologically I was coached, but I wasn't prepared to see it right in front of my eyes happening so quickly. So I think also having a strategic asset allocation is quite important, and choosing to stick to it. For me, I took too much equity risk in my portfolio early on, and when the stock market crash hit, I found myself trying to rebalance more towards a safer, more risk-averse portfolio. And that was where I found out that actually I'm quite risk-averse compared to someone who can tank a 100% equity portfolio. Yeah, so that was something I found out about myself during the crisis, and I think it's important, right, to understand yourself. And I think you can always look at people's portfolio and say, oh, I can buy 100% stocks, I can buy call options, but what is right for you might be different, and it's important to find it.
Yeah, it reminds me of the Mike Tyson quote, right? You have a plan until you get hit in the face.
Yeah.
So, yeah, I mean, having a plan is really important, but having a plan that's suited for you and your risk appetite and your personal needs, your circumstances and your goals, I think that's really, really important. And bedding that down early in your investment journey is great. But along the way, we obviously learn, right, through the journey itself. So I'm going to change tack. You guys run websites, public websites. You interact with people because you have these feedback, comment section at the bottom of articles, and you interact with people. You're very public, right? So I'm just wondering, throughout this year, I mean, during March and April, but also throughout the year, how was that interaction with clients? You know, did they react negatively to anything that you wrote? You know, how was that experience interacting with that audience? You know, because I don't have that. I do interact with clients, but you know, it's a very different skill set and different, you know, experience that you have. So if you can share some of that and any interesting, fun stories that you have in those interactions. And then, you know, also maybe while you're at it, you can talk about, you know, some of the things that you did right or wrong, because we're, once again, best and the worst of 2020. Just feed that in, you know, some of your, you know, throughout this year, your journey and what you did right or wrong during that journey. Yeah, maybe you can share. From Peter.
Yeah. So I think in terms of queries that we get from readers, this year I would say there's two spectrums, right? Because one key theme has been interest rates have been falling, and it's at really low levels at the moment. So a lot of readers have been very curious as to potential ways to enhance their yield, but still using a relatively safe vehicle where you can still withdraw, let's say, the deposits out every day, still covered by, you know, your SDIC in terms of insurance coverage. So there's been quite a lot of queries on, you know, insurance savings plans as an alternative this year. On the other spectrum, there's been a lot of queries on more speculative type trades surrounding, let's say, your EV stocks, cryptocurrencies. So I think it's quite interesting mix of these two.
Yeah, there is a question about, you know, I use my money to pocket insurance savings plans to help me to earn money. My question is this a good plan?
Yeah, I think it's a good plan. To me, I personally use a few of the insurance savings plans. I think this year we saw that Singlife account came to market, Ethical Gigantic, Ethical Elastic, and also there's a Singtel Dash Easy Earn. These are all plans that, you know, give you 1 to 2% type of interest rates.
Yep.
Or actually cannot call it interest rates because they're not deposit accounts, they're actually rate of return.
Yes.
Which is far in excess of what any fixed deposit or any bank savings account is actually giving you. And at the same time, it's still covered by SDIC.
Yeah.
And currently, you know, I'm using the Singlife account. I'm able to withdraw or top up anytime. It goes back to my bank account in like 1-2 hours.
It's actually the low interest rate environment has really created, you know, a proliferation of these kind of products, right? Insurance savings plans, but also obviously Endowus like Cash Smart solutions, you know, other digital and robo platforms, and I think another one is launching very soon. I heard another one, so yet another product is out. So the only plug I'll say is that if you want to use a cash management solution, you can actually recreate anything out there on the Endowus Fund Smart cash management platform. So the Grab Invest, the Sashway Simple, you know, Sife's new Cash Plus, whatever, Money Out, can actually all be recreated on the Endowus platform, which is really the flexibility of the Endowus platform and our vision of wanting to be a total wealth platform. So I don't know if you guys have checked it out, but you guys can check it out and let us know feedback. Dinesh, your thoughts? Yeah, readership, interactions.
No,
and
I echo your sentiments or what we've heard actually. So because of the interest rates, people are thinking about, is it a good time to refinance their home? Is it because every
no-brainer though, right?
Yeah, I mean, for some people, yeah.
So,
yeah.
Okay.
But especially in Singapore, a lot of people are on the CPF, right? The concessionary HDB loans. So maybe that is not an easy decision because once you come out of it, you can't go back in. So maybe that's why for most people on bank loans. Then the second one, I've seen a lot of people ask about cash management account, about these saving plans. I think for me personally, I don't know whether it's a right or wrong thing, but this is what I do. Anything I can afford to lose 100% of, that's what is investable for me. Anything I need to use for my home renovation that's coming in 2 years, personally, this is where it goes into some of the safer products. I can't afford to lose this money. So that's just how I segregate what I can invest and what I cannot really invest, but I still want to earn a decent amount of returns. And I think just about, it wasn't too long before the March crash, the interest rates were actually going up. And if you did put it in a fixed deposit at that point, I think you could get a fairly decent fixed deposit rate, which is what I did. That's why I haven't really leveraged on the savings account, the insurance savings plans. But I think once those expire, I'll definitely be looking into that. And in terms of investments, I think we both know someone who has a very fond term for the STI. He calls it the super
Terrible.
index.
It's okay, you can say it.
Yeah. Okay, so
There's no representatives and it's not bashing the SGX or anything.
yeah, so
STI, it's
I
just
guess
an
he's
index.
Mr. Lu, right? He's not
Yeah.
someone who wants to invest in Singapore stocks or thinks that's a good index to invest in. And I think a lot of that has actually played out in market sentiments or people's opinions actually also. So just among people asking us questions, even friends suddenly asking me about Tesla, NIO. One of my good friends actually asked me to invest in Tesla about a year ago.
Right.
Obviously, I told him, it's a bit too risky for me. I'm not very sure of his business model. Hindsight 2020 again turned out to be the worst thing I could have said back then, because it's kind of like a 6-7 bagger already in the last 12 months. Yeah, so I guess some pros and cons. A lot of people asking different questions, both in terms of savings and investments.
Okay. All right.
Yeah, I actually echo what both of them have said. Many people asking about cash management product because like we saw interest rates from bank deposits like falling through the roof, 3 cuts over the year. I think people are trying to find a better space to store their cash. And
And the high savings accounts seem to go down every
Exactly,
1 or 2 months. You hear a new
All
bank
going down.
stating that,
Everything's
okay, we're
going
changing
down.
our interest
Yeah,
rates, we're
correct,
changing our
Even the
interest
insurance
rates.
savings plans.
Yeah.
Yeah, so I think people are trying to find like where should I put my cash?
Yeah.
Keeps changing. The other thing also investing globally, which what Dinesh mentioned also, people saw like the recovery of our stock market is rather lackluster. So they are looking at ways to invest globally. How do they invest? How do they set up brokerage accounts? Whether Endowus is a good platform to invest and so on. So there's a lot more appetite to invest globally beyond our shores. And the last one is also about digital currencies. I think we saw, especially the younger ones,
Yeah.
the millennials, right? They are very keen on investing, diversifying beyond stocks and bonds into these new digital currencies. And we saw like Bitcoin hitting an all-time high. So I think the interest has reignited. And people have been asking a lot of questions, having an engaging conversation about how do you actually go about it. Yeah.
Okay, that's great. We actually have a couple of questions on CPF. So maybe we can touch on that since you mentioned Lou and the 1M65 movement founder Lou. But there's 2 questions. One from Tim asking, given the uncertainty in the stock market, like what has happened this year, is it really a good idea for us to be investing using our CPF money? And another person talking about how the government will help us earn decent interest rates in CPF contributions and just questioning about CPF investing. And maybe you can just broaden that out and just take it as a CPF question about what do you guys do with your CPF? What is the right thing to do with your CPF? And specific to the investing question, is it okay? Should we invest our CPF? Who wants to go first?
I can take it.
Let's go.
So for me, I use CPF as a fixed income allocation. Right? If you are able to invest in your SA account, save in SA account 4% per annum, essentially that's almost what the same type of return you're expecting from a high yield bond at the moment, but much lower risk. And if personally I'm using my CPF for my retirement savings as well. And given our age, if we maxed out our SA account, we maxed out our Medisave account, it's actually very possible for most of us to have over $1 million in savings just from CPF, even without any like stock-like returns, just your 4% compounding over 30-40 years. For the OA account, 2.5% is still decent, and but obviously if you have a 30-40 year kind of runway, you have the opportunity to take some equity risk there. And I know that among the robo-advisors, Endowus currently is the only one that allows for OA investments. I think personally is quite a good idea. And I know Derek has also written on that topic as well. Do you have any other?
Perhaps echoing much of what you said, the SA gives you 4% at virtually risk-free rates. There's really no reason not to leave your money in there. I personally think I wouldn't invest any of my SA money. But on the OA side, I think there's one perspective maybe I want to add to that. While I think 2.5% is beatable by some of these investment products, I personally am in a situation where I'm waiting for my HDB to come in.
Yeah.
And in that particular scenario, I don't think it's wise to use any of my CPF OA at this point of time. That's because I'm not really sure what if I lose my job, at least I have that buffer to pay for my down payment when I have to, when I collect the keys. And also, I don't think I can afford to not have that safety net. So I'm not personally going to invest in anything. I'm just going to take the 2.5%. Once I'm paid up with my down payment, then maybe I can consider doing some things extra with my remaining balances. Perhaps for those who are really risk averse, you can still transfer OA to SA, right? And you can still enjoy that 4%. If you kind of want the flexibility of having that money locked into your OA, then you can invest in platforms like Endowus. You can also invest in individual stocks on your own if you want. But I think like Endowus mentioned in one of your articles, which I found one of the most interesting, the worst investor in the world, right? Over a very long time horizon still gets about 6%. And that surely beats your 2.5%. If your horizon is kind of like 30, 40 years, some of like our age today until our retirement, maybe it's wise to leave some OA money, invest that, to maybe even beat out the SA returns over the long run.
All right. Your thoughts?
Yeah, I also like to segment my money in terms of when I need them. So for OA money, like Dinesh probably need for housing, so I don't want to touch it. For investments, if I want a bit more yield, before Endowus launched their product, I was doing OA to SA transfers. But I think with the CPF product, I think it's much better to invest with Endowus, because if you're doing a transfer, you're investing for the long term anyway. So if you're looking from a long-term perspective, then investing in the equity markets might have a longer long-term return. So I think for me, personal story, family and friends investing in CPF products with Endowus, and initially they started at the start of the year, and I think it was quite unfortunate that the crash just happened right after you guys launched. But fortunately, over this year, I think they were really happy with the returns, and they coached how the markets played out. The quick recovery really strengthened the belief in the product, and I think that was really good.
Yeah, thank you for that. And I think for CPF, it just goes to show that everybody is different. So everybody has CPF, everybody knows, but actually the way we use CPF is very, very different depending on the person. And we experienced that ourselves. Like, people use, the OA for housing. Some people refuse to use OA for housing because you need to pay back the 2.6%. And, some people use it just for down payment. Some people use it for mortgage payments. They top up to SA. They refuse to top up to SA because it's even more illiquid. Once you put it in there, you can't take it out. So all these things are very peculiar to the individual personal characteristics, personal preferences, personal circumstances, personal needs and goals. And so CPF is a very flexible total social security system. So when Endowus talks about CPF investing, it really is dependent on your personal circumstances. SA obviously gives you that 4% risk-free, and we actually don't advise most people, to use a SA. But there are people who have a lot of cash savings. For CPF is not a major problem if they lose a lot. They don't rely on CPF Life for their future retirement because they have other savings plans or annuities or insurance products. And for them, SA is a punting kind of thing. They want to invest. So they keep telling us, I want to invest my SA. I said, you shouldn't invest your SA, but I want to invest my SA. So we get that a lot. And but absolutely, 4% risk-free is impossible to beat. There's no way you should be touching that. But I think the way I look at CPF is that I look at the SA as the bond allocation, because it is the 4% and possibly 5% in certain pockets. And I look at the OA as the equity allocation. And it's an illiquid allocation that you cannot have access to for, as you guys said, 30, 40 years often if you're young. And so it's the perfect pool of money to invest for that long term. And it's, equities is the right place to be if you're going to invest for that long term period. And so, I look at OA as the equity allocation, SA as the bond allocation, if you look at it from a balanced portfolio. And as Peter highlighted, it piles up. And especially if you sell your housing and you put more money in again, then that OA portion becomes compounding very fast. So that's the kind of concept I have. And you should actually use your cash for a lot of your expenses and stuff. But try to top up your CPF as much as possible and try to use it in that balanced portfolio for your long-term future in your retirement.
Yeah. So particularly for high-income earners, CPF scheme offers certain tax reliefs
absolutely,
for topping up your SA account, your MediSave account. So if you have you're paying a marginal tax rate of 10 to 20%, to me it's pretty efficient if you're just topping up your SA account to save that 10 to 20% of the $7,000 topping up.
Right.
10% essentially is already almost 2 years of equity returns, which you're getting as a subsidy from the government, right?
That is true. And since it's seasonal and since you mentioned taxes, who wants to put a plug in for SRS here? Anybody? Dinesh?
Yeah, I
SRS?
think both CPF and SRS actually, right, are dollar for dollar tax deductions that you can get. Obviously for SRS is a bit more, I think 15,300 per person.
And for foreigners, 35,300,
Yeah, correct.
which is
And for
amazing.
foreigners,
It's massive.
And also very important for foreigners planning for retirement because they don't really have a CPF account. And also SRS, you have to invest your money actually. Compared to the CPF, you can just leave it in, right? That's compounding at 4%.
Well, a lot of people leave it in, but they shouldn't because they're only getting 0.05%.
Correct. Yeah. Okay. So they benefit from the tax deductions, but you also, to maximize or optimize your benefit, you need to invest your SRS. Otherwise, you earn that kind of low, negligible interest rates. And also for CPF, RSTU, 7,000 per individual, and then another 7,000 for your loved ones, which I think can give you up to that 10% relief of your taxes depending on the bracket that you're in. So hard to beat that. And I think the only one plug-in here is that maybe people should realize they can't invest their RSTU monies. That's just going to be sitting in there, but they can invest monies outside of the RSTU. Yeah.
Okay, guys, we're running out of time. So last question is from the audience who is asking, is buying a house a good investment? So let's share a view on property, a view on crypto, and a view on equities for 2021. So put your hand up for who's going to take the property.
I can do the property question.
Right.
Yeah, so I think we're in a generation where, property might not be as lucrative in terms of the returns compared to our parents' generation. I think there are a few reasons for that. One is now the down payments are much heftier, right? 25, 30% kind of down payments you're looking at. In our parents' time, the down payment was 10%, right? During the financial crisis, the US, some banks are even willing to give you the full 100% loan, or more than 100% of your property as a loan. So with that kind of leverage impact, and with Singapore growing as a developing country to a developed country, we were able to benefit from that kind of property, massive appreciation in those prices.
Yeah.
But now, I think it's a bit more difficult because our population size is kind of stagnating, more stable now.
Yeah.
Economic growth in Singapore is also slowing down a bit.
Yeah. And I think we don't see those spikes anymore because of the cooling measures as well.
Yeah.
Right. So maybe it goes up gradually, slowly, maybe.
Yeah. Rental yields locally are low, like 2 to 3%.
Yeah.
So my thoughts are, if I were to invest in property in Singapore, perhaps for my residential property, but if I want to invest more than that, to me, even REITs might potentially be better because at least it's liquid. The lending value on these stocks are about the same as what you would get with an investment property, right? And the transaction cost is so much lower because you don't have to pay for additional buyer stamp duty for your investment properties, or seller stamp duty if you sell it too early. That's my view.
Yeah. Anybody want to take a crypto question?
Crypto, I think you're best suited. You're the only one out of all of us to mention crypto.
So I think crypto to me is like a different asset class that is not really well known, not as liquid as traditional asset classes, as brand new, right? But I think there is an emerging tech stack where people are actually building applications on crypto, where there's decentralized lending markets. There are even ways to custodize a crypto, tokenize assets on a blockchain. So I think it's an evolving asset class. We are still rather in the speculative stage of things, but I think as this whole like industry matures, there are a lot of investment opportunities that might not be found in the traditional finance space. But so I have no investment preference for crypto, but I think it's a growing and interesting asset class to look at.
Yeah. Just interested to ask if you are invested in crypto.
I am invested in crypto, but not a huge part of my portfolio.
Okay.
Yeah.
I think it's okay to have a small allocation, right? Do you have a target price for Bitcoin?
It won't be zero.
Dinesh, you want to provide some outlook for the stock market or financial markets in general?
I think you're probably the best person for that, but maybe I just share my thoughts on my portfolio anyway, right? So I think in terms of what I'm going to do, I'm going to continue hodling. So I'm just going to hold my investment portfolio. Like I've already withstand the 50% drawdown without selling, I'm just going to continue holding it. I don't think it's going to fall 50%, even if it does correct a little bit more going forward. And I have a strategy of maybe unintended strategy really, because I started off investing in the Singapore market, and only more recent years I invested in US market. So I have like a mix of Singapore stocks and US stocks, even though I'm trying to put new money into foreign markets a little bit more. And Singapore stocks are good for one reason. They have quite high returns actually. They give pretty decent dividends compared to US stocks. And the US stocks that we talk about usually are the growth ones, right? And so I'm trying to maybe allocate my portfolio in that direction, where my Singapore stocks is my income portfolio, and then my US stocks is where I have it as my growth portfolio.
Okay.
Yeah. And that would make sense from a withholding tax perspective as well.
Correct.
Right, for your dividends from the US.
Yeah.
Yeah.
Okay, that's great. So we've gone over our time again. We always do this, and it's so much fun, and we could talk about so many different things all night, and that would be great. But I think we'll have to let our audience go and cut this here. But any last comments on thoughts or sharings that you wanted to provide to the audience before we wrap it up? Any advice on investments and personal finance this year to your audience or ours?
I think if I had to give myself one advice, just continue investing periodically, regularly. And so you benefit from any market upturns, downturns. At the end of the day, you will get that average price. Whenever you have the extra sum of money, that's when you go in terms of, I see 10% drawdown, I'm going to invest. So you should have a regular investment strategy, and then also maybe another strategy to like put in lump sum. That's something I have really learned personally.
For me, I would say sometimes the best investment is also in yourself. Upskill, learn a new skill, try something new. These are things that we sometimes take for granted, we don't consider, but also because over the long term, even an investment in yourself will compound throughout your whole life. So that's something that it's worth sharing.
For myself, I would say don't take too much leverage. So personally, for myself at least, I've been looking somewhere I'm comfortable with, somewhere about 25%. So if I'm buying $100 of shares, $25 can be borrowings, $75 can be using cash. If you are using this level of leverage, even if you hit the worst kind of situation in the last 20 years, right, where 07 to 09, your MSCI All Country World Index was down 58%, and let's say you invested in a diversified vehicle like a global stock ETF, you will still be very unlikely to be hit with a margin call. And obviously on top of that, you should have 6 to 12 months of buffer emergency savings for any circumstances that you need, and just in case you need to top up any margin calls as well.
Okay,
that's
great,
an emergency, I guess.
Okay, guys, thank you so much. It was a real pleasure having Peter and Dinesh and Derek here from InvestQuest, Dollars and Cents, and Better Spider, some of our favorite personal finance websites here in Singapore. So please go and check out their websites and subscribe. and receive some great content that will help you towards better investing and better outcomes. So that leaves me to just thank you, everybody, for joining us tonight. Have a wonderful, love-filled, happy holiday season, and we look forward to seeing you in the new year. Okay, wave, guys.
Right.
Okay.
Merry
Good night,
Christmas.
everybody.
Guys,
Merry Christmas.
Christmas.